What's going on, guys? Brian's here. Today is Tuesday, August 30th, 2022. Now, unlike a lot of my other videos, this one is going to be focused mostly around price action, as well as how to come up with a trading plan around key levels. So in this case, we'll be talking about the 400 level on the SPY right here. If you trade the SPX, this information is just as valuable as well as any ticker. If you consider yourself impatient and it actually ends up messing up your trading, this video will definitely help you, as it's something that I like to do whenever we're around key levels. I generally will wait for price action to break the key level and then retest the level before taking a trade. I've done a video on the YouTube channel before. It's called Why the Break and Retest Strategy Works. I believe that's what it was called, but I'll leave the link in the description down below. It's just the psychology in which I walked behind in that video on why it works. In other words, let's just say you are looking to go long the market. You don't want to go long as we're going into an area of presumed supply because there's likely to be sellers in this area. You can wait for price to break from that level, then come back to the level and then look for your entry. The reason this is super important or easier to trade is because you have a defined stop loss. You know, if you get long in this area because you're expecting price to continue, so in other words, it came from here, you're expecting it to go up, pull back, and then continue, you know your stop loss in this area is defined. You can just set a stop loss if it closes below the zone. If you're buying as price is just flying, or you don't know where you're buying, it's very difficult, because let's just say price is just flying right here. You buy it on this big green candle. Where's your stop loss? Is your stop loss going to be all the way below this wick? Is it going to be below this low? You're opening up yourself to way too much risk, and then you don't really know how much reward you have in this case here. You can't really measure your success that way. Versus if you tell yourself, I'm going to go long here and I'm going to give it a stop loss of maybe, we'll say, about this much, you can say you're going to target about 3 times that much, and then you'll get a good risk reward ratio. And a lot of trading is based on risk reward as well as probability of success. As we jump back to the charts, this is the daily chart. Let's actually just zoom out and actually plot the 400 level on the chart, because we know for many reasons, I've talked about the 400 level on this channel many times before, but let's just plot it out right now. Here is 400, and then we'll make it a nice solid thick level so it's not going to be mistaken with any other level. Not that there's any other level on the chart. This orange SMA on my chart right here is just the 50-day moving average. Not really important for the case of this video, but we can see that there's a little bit of confluence here, so also adding to the importance of this level. If we actually dial it down a little bit right here, we get down to an intraday time frame. So what we're looking at is just a 30-minute time frame. This is a volume profile that I have aggregating based on the weekly volume profile. So each one of these blue rectangles signifies an entire week, and then we can see the volume profile for each of those weeks as well as points of controls. If this is your first time seeing this, I have a playlist on the channel going over a lot of this type of information, how you can use it to trade. So something that's important right here, if we were to put, let's just mark this point of control down here for that week, change the color so that way we know what it is. Again, I've done this on previous videos on the channel, so you can always check those out here to get a little bit more information for that. So we have a virgin point of control in this case based on the weekly time frame, and then we have a key level, this 400 level. Now let's dial it down a little bit more and let's go to the intraday price action, and we can see it with the candlesticks. Let's actually turn off all of our studies here just so we can see clean price action. Now, if you're someone that's impatient and the market decides to go down and you want to decide to short, you want to get puts right here, this trade opportunity is not that good, because you're actually shorting into a level that there's likely to be some sort of buyers defending this level. In this case, you guys can see that the price sliced right through it. However, the easier place to get an entry would be on the retracement right here, because as price is selling off and it bounces back up to this level, there's likely to be people that purchase shares or purchase call options or purchase any type of long position here. They were in trouble as the market was selling off. Now, as we retrace back to this level, this is an opportunity for them to close their positions for a break even. These people that purchase here, closing their positions here, helps the selling pressure kick in. And this right here is likely to lead to future supply. Let's actually dial it down a little bit more. Now we're actually looking at a smaller time frame. So this right here would be a 5-minute time frame. And let's put the levels on the chart right here so we can see them. So here it goes. You guys can see this. Market opens up, and let's just say you hesitated at the open because you were nervous, you weren't really sure because price action was very choppy, or you wanted to wait for a clearer setup. As you guys can see, there wasn't necessarily a clean setup, as price kind of stalled out a little bit at the power hours low from yesterday, and then we just sold right off. This happens very quickly in real time. Obviously the market is closed now, so it's very easy to see this. However, if you're the type of momentum trader that you like to take the trade on the break of the previous day's low or the break of the previous day's high, you guys can see that the market just sliced right through the level. There wasn't really a lot of risk reward left in the the trade, because if you were to short on that break, you're essentially shorting from maybe about a point and a half, which is a tiny short to take. Where's your stop loss going to be? Now, if you're an experienced momentum trader, you know to just put the stop right over here, because either the trade works out pretty quickly or it doesn't. In other words, you may be risking, 50 cents to gain $1.50 out of the trade. So that's a 3-to-1 risk reward ratio. If you're new to trading, it's very difficult to make those trading decisions very quickly, because you're just thinking about how far the move has already happened, and then you already know there isn't really much more room left to go. And you guys can see right here, this is difficult to hold through this. So as we look at the chart, obviously you can say if you shorted right here and you bought puts and you just held it, obviously it would have worked as price continued to sell off. However, during this 25-30 minutes or so, as price is consolidating during this period, it's not psychologically easy to hold when you're trading short-term put options. So I'm talking about options that expire in a day, maybe options that expire on Friday, which would be 3 days from now. Things, as we know, are much more dynamic when you're trading real time and live, especially when you're trading short-term price action such as intraday scalps. This level right here, knowing that the SPY was likely to come back to this level and break the level, this was something I was prepared for from weeks ago. So in other words, I've actually done a video at the beginning of the month of August talking about how the SPY, I was entering some butterfly spreads targeting 400 for the end of the month. Those spreads are actually up really well right now, and that video was just on a gamma exposure analysis of the market, which I think would be a good segue to the quant trading app Discord. So this right here is the quant trading app Discord, and this is just from yesterday. So yesterday was just talking about there's a lot of gamma exposure at the 400 level, so we can see that on the chart, and I was just talking about how that's a dominant level. You don't really want to be shorting into the level. Let the level break and then let it retrace and then look for the short, because this is a level we know is going to be in play, as a lot of traders, almost anybody involved in the US stock market is going to be involved at this 400 level, or at least actively watching it, even if they're not partaking in any type of trades. This is making big news. If you turn on CNBC, they're going to talk about how the S&P 500 is at the 4,000 level, which is the equivalent of the SPY being roughly close to the 400 level. So everyone right now, if you're involved in the stock market, is aware of this level. If we continue right along here, I was just saying a level like that doesn't just give out easily, as that information was for yesterday, just letting traders know, anybody that was looking to short yesterday, it was not the day in which you'd want to short, because why short going into the level? It's more than likely going to have some sort of bounce or something like that. And then don't short going into it, because the risk is exponentially higher versus waiting for it to break, let it retrace. Again, if you're a momentum scalper and you know how to get in and out of a move like this, most scalps for a lot of experienced traders, if you're trading on a micro time frame, a trade that lasts 3 minutes is actually a long trade. So 3 1-minute candles going in your favor. Usually scalpers are already starting to take risk off, which means they're locking in some profits. Again, newer traders are not that good at being able to make these decisions in smaller time frames. Going back to this post right here, I was saying even if the SPY does break the level, it will drop to something like the 396 to 395 and bounce back up to 400. That's where it would be much safer to short. Shorting into a level like that is asking for a headache. That is too risky for shorts on a day like yesterday to be looking for puts. On a day like today, completely different story once we break down that low of day. More importantly, it's even less riskier to actually take the short on the retracement right here. Now, where did I get that 396, 395 level? It just came from understanding the volume profile. So again, as we jump back to this right here, we can see that there's a lot of high volume nodes in this area. So if we actually just drew a demand zone over this entire area, and then let's actually change the color, because this is again something that I've done many of times on this channel, and we lower the opacity, and we can see right here. Now we jump to the intraday time frame with the candlesticks, and you guys can see the market sells right off into this demand zone, and buyers are here, as well as more than likely shorts are covering. So anyone that shorted from all the way down here, this is a great place for them to take their profits, because why short into such a strong demand zone or expected demand zone? Let price retrace back up to this key level, and this is where you look for your short. If I actually turn on these studies, or if I actually turn back on my studies right now, we can see we can look for something that's referred to as confluence. So these levels on the chart are from the quant trading app algo. Link is in the description down below for quant trading app. These levels plotted on my charts. This purple level right here is the absolute gamma strike for Friday's expiration. This right here is an intraday quant zone, and then we have VWAP, so the regular intraday VWAP. So we have 3 confluences in this area, and you guys can see the last piece, or the last icing on the cake, as I've mentioned many times also, is look for some sort of wick rejection off of the zones. So if you understand how to read shadows and wicks on candles, this is something that's pretty important because it's showing the conviction behind any type of participants at this price point. So in other words, the sellers were very aggressive. Price couldn't even stay over VWAP. It couldn't even stay over this zone, and it couldn't even get past 400 for less than a few minutes. It was instantly rejected. That right there becomes your level to risk off of. In other words, if you decide to get short here, you can easily put your stop loss on a close over this level up here. So in other words, this becomes your stop loss, and then your target ends up becoming low of day down here. So you're targeting all the way down here, and that's a good risk reward ratio, because if we were to mock this up, again, if you're really quick, I actually caught the short right within here. If you're really quick, you can catch it up there, but let's just say you're a little bit slower and you want to take your time because you're not sure. That is our risk. Here comes a 1-to-1 risk reward ratio. And if we duplicate this again, this is now a 2-to-1 risk reward ratio. And then if we duplicate it one more time, we can see it didn't quite complete a 3-to-1 risk reward ratio. So this is about a 2.5 risk reward. You were risking this much and you were gaining this much. That is a good risk reward ratio. If you got the trade all the way right at VWAP, right in here, if you're trading on a smaller time frame, or you know how to read the tape, or you have any other indication. In my case, I didn't need any extra confirmation because again, I prepared for this trade from a couple weeks ago, expecting the spot to come down to 400. I already told myself, as I mentioned or reiterated in the Discord yesterday, as the 400 level broke, just wait for it to retrace to this level, and you can look to catch the short down to low of day. Now, within the chat right here, let's just continue to scroll down and see what else right here. Now in the chat, as we continue to scroll down, just pointing out the bear flags on the larger time frames, but more importantly, these are the key POCs to have and watch. So this is the ES futures right here. So this is actually where the market's bottom ticked right here, touched this level before it bounced back up to the 400 level. As we continue right along, this is when I came in and just said, remember what I mentioned yesterday, let the market break 400 and then it will probably retrace from 396 back up to 400 and look to take a low risk trade. That was us coming right back up to this level. As soon as we touched VWAP, I was already starting to mock up some of my trades. As we continue right along, we can see this is where the ES ended up going. So again, just making it a little bit larger so you guys can see it bottom ticked it right here before it bounced. And that's just coming straight from the volume profile right there. And then we can see how the trade ended up working out as we ended up selling off here. Just made sure to mention that this is where you're going to want to start taking profits. So you always want to take some sort of risk off, shorting into low of day in case it ends up being a double bottom. In other words, as price is coming down here, don't be greedy and expect price to keep going right here. This is our low of day. You want to take risk off going into the low of day because there might be buyers in this area looking to defend the low of day, and price is likely to bounce back up. And that's what we can see ended up happening. So price did breach the low of day very briefly before we ended up rallying back up to VWAP. Let's switch back on some of our levels here, and now we can see demand zone. We can see this level was broken. We know there was a lot of high gamma exposure in this area. Now, why does this work on a psychological level? Anybody that was looking to defend the 400 level, so this is price selling off right here, we can see that buyers were here. They were trying to hold price up. They were getting aggressive. They were trying to push price higher. However, they could not stop the selling pressure. Sellers were a lot more aggressive right here, which means they were selling into the bid. This level broke out. A lot of stop losses probably triggered right here as the tape sped up and the selling just started increasing exponentially faster. However, anyone that did not get out here, this was their chance. So if, in other words, if you buy at 400 and the market sells all the way off to 397, you're down $3 per share. Now, as the market bounces back up to $400, you're now down $0 per share. This is your chance to close out the trade because you thought by buying at 400 that the market would go back up. However, it didn't go back up. It continued to go lower. So this is your chance to close your trade out for break even. That's the psychology behind why this works the way it does. To wrap things up, let's just take a look at some options. What we're looking at is the 1 day till expiration 399 put, so one strike out of the money right here. So this is, we're talking about shorting at 400 and getting a put that's likely to go in the money if you are right. And we're talking about this time frame right here. So this is the retracement. Market sells off and it comes right back to the level. You instantly know where you're going to put your stop loss. In other words, if you get long anywhere within this 5-minute candle here, you're essentially risking maybe 20 cents, 25 cents, and look at the reward on a trade like this. This actually went all the way up to $4. If you're taking your profit target in this vicinity here. You're getting out anywhere between $3.75 up to $4. So from a risk reward standpoint, you're talking about risking maybe 30 cents, we'll say 40 cents, and potential profits is $1.40 all the way up to $1.77. So in other words, 77% all the way up to potentially 80% anywhere in this area, because you're getting 5 minutes to get filled, and this is a trade you can prepare for in advance. You had the first warning here, so this is the opportunity to pull the trade up as the SPY was actually retracing to the level. Next, for a little bit more of a safer trade, you can actually trade something like a 3-day till expiration. And again, I don't trade these options very often in terms of the weekly options, but when there's a setup this clean and a setup that I'm this prepared for or expecting, you can trade these short-term options because you know how much you stand to lose, and there's plenty of time to be prepared for beforehand. And as we review this one, we're talking about getting filled somewhere around 380, 360. So assuming you're filled here, even $4 if you're really slow to get filled in the trade, or you decided to get it early. The max drawdown was about 40 cents, so you're risking about $40 per contract, and you're taking profit somewhere around here at $1.25. Max profit back at the higher day on this contract was $1.60. So great risk reward. You're risking about 10% to make anywhere from 30 to 40%. So a 4-to-1 risk reward ratio, and that's exactly what you want in your trading. Even a 3-to-1 risk reward ratio is excellent. In this case, this is a 4-to-1, but it's not always going to be a 4-to-1. Even a 2-to-1 risk reward ratio is really good if you know what quality setups to look for. Hopefully you guys enjoyed this video, and let me know if you want to see more price action videos. Again, I don't take much intraday scalps unless it's something I can foresee from a couple days in advance, or I'm expecting to happen, as it gives plenty time to actually prepare for the trade, know what contracts I'm going to trade, know exactly, I can visualize what the price action is going to look like before it happens, and that really helps with the intraday anxiety that you might be facing. If you can visualize it beforehand, it helps. It happens across the board in almost anything. If you've ever played on a sports team, you might have had a coach tell you something like that before. You want to visualize how things are likely to go. If you're into meditation, if you're into anything that's cerebral that helps with mental preparation, a large part of success and a lot of things that people do is being able to visualize it before it happens, and that works for me tremendously. In other words, if I can't visualize or expect something to happen, I generally will not participate in it, and that's what makes me not necessarily a great momentum based trader. And I've said that many times before. I don't really like trading the momentum because it makes me very uneasy. It's difficult for me to know exactly where I'm going to put my stop loss. This price is moving pretty quickly, so I'd rather just stay patient and wait. Thanks for watching, guys. Like the video if you enjoyed it. Leave a comment if you learned something. I'll catch you guys in the next one.